What's up traders, it's XViper TV and welcome back to the channel. Have you ever jumped into a clean breakout, everything looks perfect, and then bam, price reverses hard and leaves you stuck holding the bag? Or worse, you get stopped out only to watch price take off without you. These fake moves aren't always random, and today I'm going to show you how to spot them before they happen using CVD divergences, one of the most underrated tools in a trader's arsenal. We're going to break down what cumulative volume delta really tells you, how to identify trap traders, and how to use these divergences at key levels like VWAP, initial balance, supply and demand zones, and daily highs and lows to catch high probability reversals. Now, if you caught the last video, we covered stop hunt traps and how smart money uses liquidity to run your stops. This video builds on that and gives you the insight to confirm whether a move is real or fake. Now, before we get started in this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, what is CVD and why does it matter? CVD stands for Cumulative Volume Delta, and it tracks the net difference between aggressive buyers and sellers. Think of it as the heartbeat for order flow. Are buyers pushing the market, or are sellers stepping in hard? When price is pushing up, but CVD is falling, or price is pushing down and CVD is rising, that's what we call a divergence. This tells us that even though price appears to be trending, the underlying volume doesn't support the move. A major red flag that a reversal could be coming. Now, why does CVD divergences protect you? Most retail traders enter on emotion. They see green candles or red breakdowns and chase the move. But smart money does the opposite. They look for signs of weakness and strength and weakness. CVD divergences let you see behind the curtain. They help you avoid fake breakouts and breakdowns, spot potential reversal zones, time better entries with less risk, and even fade moves that are running on weak participation. Now let's get into where to look for CVD divergences. CVD divergences are most powerful when price is testing key levels. These are the areas where traders make decisions and where institutions trap the most people. Look for divergences at initial balance high or low, especially during the New York or London session. VWAP, a key mean reversion and value reference. Supply and demand zones, where smart money enters positions. Daily highs and lows. These are liquidity magnets where traps often form. Now let's go into how to spot CVD divergence. Here's how you spot them. Bearish divergence. Price makes a higher high, but CVD makes a lower high. Bullish divergence. Price makes a lower low, but CVD makes a higher low. When this happens, it signals a disconnect between price action and actual order flow. Pair this with structure shifts like change of character or break of structure, and you've got a sniper entry opportunity. Example, let's say price is testing a strong demand zone at the IB low. It breaks slightly below the low, grabbing liquidity, but instead of CVD continuing to drop, it starts to rise. That's your first clue that sellers might be getting trapped. A few candles later, price forms a higher low, breaks structure to the upside, and prints a bullish engulfing candle. That's your sniper entry, backed by order flow and structure. Now here's a simple way to visually confirm divergence on your chart. Just draw a line connecting the most recent swing highs. If price is making a higher high, but CVD is sloping down or showing a lower high, that's a clear bearish divergence. The same applies for lows. If price prints a newer low, but CVD fails to confirm and prints a higher low, that's a bullish divergence. It's a fast and reliable way to confirm what you're seeing, and it adds the extra layer of confidence before pulling the trigger. Now, the way you think is just as important as analyzing the market. Don't get emotional when price fakes you out. Learn to see it as a setup, not sabotage. The market isn't out to get you. Most of the time, it's a larger player defending a position, collecting liquidity, or just reacting to a deeper order flow. By watching CVD at key levels, you'll start spotting where retail is trapped and where the real move is about to begin. Now, in the next video, we're going to cover one of the most important things in trading, and that's risk management and proper stop loss placement. How to stop giving back your gains and protecting your capital, and stop second guessing every setup. Even the best strategy fails without risk control. So make sure you're subscribed and ready for that one. Now, if this video helped you spot something new, hit that like button, subscribe, and drop a comment if you've used CVD Divergence or if you're excited to get started. Let's build that edge one level deeper. This is XViper TV. Thanks for watching and happy trading.